And stocks continue marching higher. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And as we get into the final hours of the tradable 2023 year, we have just 2 days left before the calendar is going to turn. Markets continue to drift up. Stocks setting record highs on Wall Street. We have bond yields continuing to crack lower as bonds rise. Seemingly, the markets continue to be imbued with a sort of relief as the year ends, and yet the economic data behind all of these moves is sending up something of a warning signal. And what we'll focus on here today is the last little bit of relevant economic data due to hit the wires here before the calendar year end. And it comes to us from China by way of rounding out December's Purchasing Manager Index roundup with that set of data. We've seen now numbers out of the U.S., we've seen numbers out of the Eurozone, we've seen the updated PMIs out of most of the major economies to kind of get a sense of where the global business cycle is. China will finish out the December PMI reporting run. We'll get final revisions next week, but this last bit will really help to set the stage to understand, even as markets cheer, even as everything seems about as rosy gets, the specter of global recession is not only drawing closer, but escaping a global recession looks increasingly like an impossibility. So first, we're going to take a look at what this data is due to show and see why it looks as dire as it does, and then put it in the context of what's been going on in markets and how this data clashes directly with those moves. So let's begin with initially just getting a sense of these expectations. So we're looking for the manufacturing sector in China to remain in contraction mode. This is, as ever, in the logic of Purchasing Manager Index data more generally. So 50 is the center line. That's where there's neither growth nor contraction. Above 50, there's expansion. Below 50, the sector in question is shrinking. The further you go above 50, the faster the growth. The further you go below 50, the faster the shrinking. And so what we can see here is that the expectations call for manufacturing to shrink yet again in China. The expectation is 49.6. The overall economy seeing a little bit of growth, and that's because the service sector is seen squeaking out a bit of an expansion. So slight growth in services yielding a modest pickup in the overall economy, but so close to that neutral reading at 50 that it might as well be at standstill. And of course, this is a very troubling set of numbers when we consider just how important China is for global economic growth. Looking at the breakdown here as of the end of last year, we'll obviously update this as this year comes to a close and the percentages change. But most recently here, China is 16% or close to a fifth of global GDP. Combine that with about 12% for the Eurozone and 22% for the US, and you have 50% of global GDP just between those three economies. And that's at face value. It's actually even more. Because the globalized economy that we find ourselves with, despite kind of assaults on globalization over the past 4 to 6 years, lend themselves to a setup where you have substantial dependencies baked into this pie. And so unpacking them to say this economy accounts for this much and this economy accounts for that much is a difficult exercise because so much of it is interdependent. So looking at the rest of world, 50% here, most of the economies on that side of the pie are vendors serving demand in the three economies in the Eurozone, the US, and China. Think Canada, Mexico, and the US. Think Australia, most of Southeast Asia, a lot of Latin America, especially the commodity producers for China, or Central and Eastern Europe, or Nordic Europe for the Eurozone. So the influence of the three major growth engines is actually even bigger than 50%, because the other 50% depends on them growing to have growth of their own. The interdependencies get even more concentrated when we consider that China is itself a vendor and depends on demand from the US and the Eurozone, because China occupies a kind of middle step in the global supply chain where raw materials are sourced, semi-finished goods are sourced from all over the world and then go to China for value add processing to have either finishing or more finishing done, and then move on either to be sold in end demand markets or to go to the next level of still more value add production. But in the global economy, China, despite kind of the knockback that it took during the COVID years, remains a less dominant, but nevertheless a dominant node in the middle of the global economy, adding a vast amount of value add to a vast amount of the global commercial pie. And so China, much like this rest of world piece of the pie, is dependent on there being end demand in rich world consumer-driven markets, the Eurozone and the US, in order for it to have something to do in the middle of this global supply chain and thereby to generate economic growth. And the story here is not encouraging. So we can see here that just as China is near standstill, so too is the US, is doing a touch better, but nevertheless is hugging that 50 center line closely. Meanwhile, the Eurozone is in outright contraction and has been there for quite a few months. As a matter of fact, we now have, with December, 6 consecutive months in sub 50 territory for the composite Eurozone PMI, telling us that a recession there is essentially a done deal at this point. So if this is where demand comes from, it's difficult to imagine how this pie grows. Because if the Eurozone is at standstill, the Eurozone, or if the US is at standstill, rather, the Eurozone is shrinking, China is at standstill, but it depends on the former too, and everybody else depends on the preceding three, well, then it's difficult to see who is doing the buying that then powers the output that then generates the growth. Now, this is certainly not lost on sort of the market watching public. So if we look at how the sort of consensus view on global growth for next year and the year after has looked, we can see that there's been a fairly steady trajectory from the upper left to the lower right. Not exactly what you want to see. A steady stream of downward revisions for GDP growth expectations next year and the year after. This is a survey from Bloomberg that polls market economists, strategists, and so forth. We can see here they have steadily and mercilessly notched growth expectations lower essentially all year long. What's particularly striking here is that even this seems to be too optimistic. This is a data set from Citigroup, and it shows the performance of economic data relative to baseline forecasts. So when the data misses relative to the forecasts, the index goes down, and it's helpfully scaled by volatility. So the more market moving the news, either up or down, the more the index goes up or down. And we can see here that in particular, starting in November and December, the view globally for developed markets and for emerging markets looks increasingly dire. So whatever these expectations are, though they've been coming down, what this is telling us is they haven't been coming down enough, because the data keeps surprising on the downside of those expectations, especially for developed markets. We can see, of course, that's because the Eurozone is already in recession. It's such a big part of the developed markets grouping here. So the global economy is approaching zero, so approaching the place where data starts to systematically underperform relative to forecasts. It is already there for developed markets. It is not quite there, but has been, so we can see here, clearly deteriorating in line with the overall story for emerging markets. So all of this seems to say the global growth picture isn't just bad. It isn't just seems to be getting worse. The degree to which economic data informs expectations suggests that those expectations are not dour enough, that the growth picture is pointedly worse than economists' models have it. Now, this is what makes the performance disconnect between what seems to be economic reality and market reality so stark. We can see here in the purple is the MSCI All Country World Index ETF, so ACWI. This is the world stock index, as it were. And we can see it is on pace to be up nearly 20% this year. If we consider what seems to be powering this move, we can see clearly emerging markets, not the big story here. They're up just 5.2%. If we take a look at those same emerging markets and we factor out the terrible situation that we see in China, where stocks clearly have noticed that that economy is struggling, the ASHR ETF here, which captures the CSI 300, China's kind of all-in answer to the S&P 500, that's down almost approaching 17.5 currently percent. Take China out of the equation and emerging markets excluding China, that's that blue line there, they're up a commendable 16.4%, but that's still a pittance relative to the overall situation globally, and that seems to be powered by the U.S., where SPY, the S&P 500 ETF, is outperforming not just what's going on in emerging markets, certainly not just China, but outperforming the world average as a whole, and by a significant margin of over 4%. Seemingly ignoring whatever else is going on the growth side, ignoring recession risk. And the driver is not one that needs to be particularly difficult to surmise. We can see here that really since the beginning of the year, the main influence on stocks seems to have been the path of Fed policy expectations. In the gray bars here, what you see is the amount of rate cuts expected for next year and how that's evolved since about the middle of this year. And what we see is that when we started at about mid-year, we saw the markets expecting anywhere between 1 3/4 to 1.5% in rate cuts. That's this right here. And of course, that came with the markets having just suffered through the regional banking crisis led by SVB, Signature Bank, First Republic, the very rapid shotgun marriage of UBS and Credit Suisse. And so the markets were clearly sort of angling for there to be more turmoil after all of this. It certainly didn't help that at the same time there was a fiscal headwind in the offing because U.S. lawmakers couldn't agree on extending the debt ceiling. And that, of course, for all the talk about default, doesn't mean all that. The probability of a U.S. Default even having a price as a scenario in global financial markets that are built on the premise that the dollar is the go-to currency of commerce, whereas the U.S. Treasury bond is the go-to risk-free benchmark for all markets, really. There's really no scenario in which the markets would go, here is where various asset classes would be if those two assumptions were violated. I mean, that basically speaks to the collapse of the entire system as it exists. Rather, what the debt ceiling was a sort of fiscal headwind, basically saying if the government were not to pass an extension, then some spending would stop, and that would be a slowdown of U.S. economic growth, and that slowdown would then demand rate cuts because it would give us a much weaker economy than otherwise. As it happens, neither of those things actually materialized. The debt ceiling was extended. The regional banks were ring-fenced with some creative Fed policymaking, allowing them to borrow money on very favorable terms should they run into some kind of a funding issue. And so what we started to see from mid-year was rate cut expectations started to fade. And what's clear here is as they are fading, stocks are going down because the story essentially becomes financing economic growth will now look more expensive than it did with all these rate cuts on the table. Essentially saying rates are going to be higher and they're going to be higher for longer. And so that, of course, is something that makes financing any kind of economic activity, be it the purchase of a washing machine or the building of a new factory. Makes all of that much more expensive, and of course, also hits at consumers. As we know, consumption is overwhelmingly the lion's share of economic growth in the major economies, in the US, in the Eurozone. It is on the order of 3/4 of economic growth. And of course, as we just saw here, it's those consumers that carry on their back the entirety of global growth, because it is those consumers that China relies on to power its middle of the supply chain growth model. It is, of course, then the Eurozone, the US, and China that everyone else depends on. And at the end, it all rests on US and Eurozone consumers, which, if you were to face them with higher interest rates, might consume less. We already see that the US consumer is creaking under the weight of credit-financed consumption as delinquencies rise. So, not surprising here that when we present the markets with rates being higher than they thought, or likely to be higher than they thought, stocks swoon. We can see here, likewise, that the situation flips as those rate cuts start rebuilding. And of course, here with particular emphasis in November and December, stocks roar higher as the Fed basically embraces the case for rate cuts and says, right, it looks like the global economy is indeed slowing. It looks like we've done enough to contain inflation against that backdrop. We'll commit, as of the December summary of economic projections, to 3 cuts in 2024, or at least we'll telegraph that much in easing at this point. And of course, stocks repeat their performance from mid-year in reverse. As rate cuts build back to where the outlook stood closer to June, July, so too stocks roar upward, take out their former highs from mid-year, and extend. So much so, as a matter of fact, that at this point, the markets envision 6 cuts with a significant chance, about a 42% chance, for a 7th one next year. That's almost 2% in rate cuts. If we consider that a single rate cut is 25 basis points or 0.25%, 7 of them, which is a huge amount, would be 1.75% in reduction. And of course, if we just look at where we were at mid-year for context, that's about comporting with imminent crisis level easing. Because, of course, the last time we saw things like this, it was these funding, banking, and sovereign risks that investors had on the mind. It also doesn't help that the timing seems to be additionally of concern. Looking back to the recent run of rate hike cycles, going all the way back to the 80s, where ostensibly the current financial system really gets its start, first with the decoupling from the gold standard in the early to mid 70s, and then to Paul Volcker's battle with inflation that saw the Fed hike rates as aggressively, if not more aggressively, than this latest round. This was certainly the most aggressive rate hike cycle since then, and really quash inflation to give us about 4.5 decades of perpetually lower inflation and perpetually lower rates, every single time that we have seen a meaningful rate hike cycle, it has been followed with about a 2-year lag by a spike in market volatility. And in the green here is the Fed funds rate. We can see that here is sort of the post-Volcker settling of rates. And just as rates then go into a rate hike cycle with about a 2-year lag again, volatility spikes. As rates stay elevated, so too does volatility. As they come down, again, with about a 2-year lag after this rate hike cycle starts, we get the '08 crisis. Things settle as rates hold at zero. Bit of a pop for the Eurozone debt crisis here. It happens somewhat less cleanly because, of course, COVID is something that you couldn't really pin on the Fed as having broken with rate hikes. But certainly there does seem to be some modest upward pop here as this rate hike cycle begins in 2015, 2016. That would put us at the moment, which has been a much steeper and a much higher climb in rates, right on time, as it were, for another volatility jump. It'll be exactly 2 years to the start of the Fed's tightening campaign in March of next year. So in so much as this is not a perfect 2 years, there's some months variance here, both forward and backward. There's very much the sense that we're right in the window for the markets to rediscover gravity, for this detachment from the economic fundamentals to perhaps reassert itself, and for the incredible surge in stocks that we've seen here in the last 2 months of the year to give some ground. Now, whether the Chinese PMI data ultimately sets the stage for that kind of thing, of course, remains to be seen, but it will certainly be an important reminder for investors that what this stocks rally is built on is an expectation of cheaper money. And that cheaper money isn't coming because things are going great. Interest rates don't generally get cut in response to economic strength. They get cut in response to economic weakness. And as we look at what the global economy looks like on the way into this calendar year turn, escaping a global recession seems increasingly impossible. Whereas looking at stock markets, the idea that any kind of an economic issue is happening below the surface is apparently missed altogether, unless it is Chinese stocks specifically that are in question. Almost as in 2008, the markets thought the U.S. would decouple, have its little mortgage crisis while everything else would keep growing. The situation here seems to think that China can decouple while everything else is going to be okay. But as we've just learned, and as we've just seen in the interdependencies between these economies, that's probably wishful thinking, with a reckoning likely not too far off, at least if what we've seen before is any indication. And that is Macro Money for today. As ever, we are here every Monday through Thursday, Tuesday through Thursday this week and next for the holidays, right after overtime. show that I co-host with Chris Vecchio and Dylan Radigan. Thomas Westwater's filling in this week as well, where we look at what's happened on Wall Street on a given day and consider what that means going forward. I am also writing for the news and insights section of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. We'll see you for the last show of this 2023 run tomorrow. In the meantime, take care.